Hey, so I wanted to talk about Sirius XM today. It's an undervalued stock. I've been doing a little bit of research on it, and I'm going to go through and show you guys why it's undervalued. So, starting with the business model, the first thing to look at is, can I understand this business? SiriusXM doesn't have crazy derivatives, confusing stock compensation on their 10Ks or 10Qs. They're mainly a radio company um, that licenses and has advertising and gets royalties as well, and they work directly with cars and they get pay directly from customers. Sorry, they work directly with automakers and customers to have subscriptions for radio, and that includes podcasts and music and streaming. And so that's a business that can be understood more easily than, say, a financial institution, insurance, things that have like a lot of working parts. So for a beginner like me, SiriusXM is a good example of something within my circle of competence. What do they offer? SiriusXM is an in-car media service based on a subscription, and they can be integrated into the car by the automaker before the customer purchases it. They offer a suite of content on their app and platform in the car, including podcasts and music. Um, they so that's what they offer. That's what they offer customers. How do they make money? They also license their radio for car radios, don't manufacture it themselves. They also make money with running ads um, on their ad services like Pandora when it's not Plus. Subsidiaries include AdsWiz, which is a software suite for people to make advertisements. So I'm going to pause right here. So first of all, we saw it's an in-car media service based on a subscription, and they can be integrated into the car by the automaker before the customer purchases it. That's extremely convenient. So, imagine you're buying a car and you're streaming and the entertainment that you would need when you're driving in a traffic jam or, just going to work in the morning, whatever situation you might use media. Imagine if that was just integrated directly into the car, that you didn't have to set up the process. Not now, sorry. And you didn't have to go through and set up the Spotify accounts or anything like that. So that's a huge competitive advantage. They offer a suite of content, so that's podcasting, music, streaming in the car, and that's many, many, many different titles of songs and art. That's one of their competitive advantages as well. But one of the greatest competitive advantages is how they make this money. I mean, they don't manufacture the radios themselves. They license the technology to radio manufacturers and outsource the manufacturing. So they save money on that, and then they just collect whatever royalties or ad services or subscriptions that customers pay to use a Sirius XM branded radio. They have other smaller sources of income, including AdsWiz, a software suite for people to make advertisements, and then also Pandora and SoundCloud. Pandora having a subscription and a ad-based revenue source. So in general, this company is definitely uh, heavily reliant on subscriptions, and subscriptions are a double-edged sword because subscribers can be very volatile. However, it's a reliable source of income. But the company has recently been shifting towards ads because of the shifting consumer taste. They spoke of the millennial taste of uh, wanting ads more than subscriptions, which is interesting. And so they're sort of shifting towards an ad-based model and for most of their things. So how do they retain customers? They have a competitive moat because they offer so many more services than AM and FM radio, just your average 99.5, those types of things. And they are integrated into the car, unlike Apple or Spotify, which must be set up by the customer. So there's that convenience, that ease, that is very attractive, that actually uses the availability misweighing tendency, denoted by Munger, which hooks the customers on the brand, or sorry, because people are more attracted to services that are most easily within reach. And so when you get your car and SiriusXM is already on it, you're like, well, that's pretty convenient. I might as well use it. So that is a big moat against competition. Some of the other small things that they get right, they also have an influence from mere association tendency. The brand hosts a whole lot of suites and content, and so retaining customers, retained customers will come back and be able to expand what types of products that they use through their product line. They can increase their subscriptions and so forth once they entrust the brand. So that's a direct way for customers who like the brand to then flip back and give value to the company even more. Finally, they have strength and size, a substantial track record, and I believe their industry does have a future. So SiriusXM is in millions of cars. I think there was a number, it was about 150 million. So that's half the population in the United States. They also have in Canada a small portion. They have millions of subscribers. So I think Pandora has about 60 million active users, and they have 34 million on SiriusXM, if I'm not mistaken, and they have billions in net income, so they're a large company. And I think the radio industry, is not going to get obsoleted. The massive majority of vehicles, I saw a number that said 92% still use radio in their vehicles. And radio is just very, very convenient to have. I mean, it's something integrated into your dashboard. And, even when you have a screen, you have to be flipping back between apps to access radio. With this, you turn a couple knobs or you press a couple buttons and you have entertainment. So I don't think it's going to go away anytime soon, radios in cars. So the green portion, I'm now going to talk about financials. Are they swimming in cash? So this is something that Warren Buffett looks for. I'm going to start with that. So SiriusXM has major depreciation charges. Depreciation charges are coming from their high amount of property, plants, and equipment. Depreciation charges are non-cash charges, which means that they're added back to the net income to arrive at a free cash flow number. And so oftentimes when you have companies like Sirius with a lot of depreciation, the net income will not always show or demonstrate the money that they're truly making. So with the free cash flow number, it's actually substantially more than the net income because of the depreciation. This allows them to have ample enough return value to shareholders. They have had consistent repurchases and dividends over time, and as well as the free cash flow number going into the capital expenditure, which is what you subtract from the operating cash flow to arrive at free cash flow. If you take a look at their 10K for 2023, they have at least 200 million in investment into expanding the network under CapEx, or capital expenditure. And the reason why that matters is because capital expenditure, when you charge it against operating cash flow to get to free cash flow, should only include maintenance-based things that maintain the business. So say you're a retail brand and you're improving the leasehold, or you're adding fixtures, things like that. But SiriusXM included a $200 million charge in 2023 for growing their satellite network. That is a necessity for the company to grow, and I think that can be actually counted towards their free cash flow. So their free cash flow is actually counted down about $200 million. So a conservative valuation, possibly. Finally, do they have a capital light business? So I'm skipping this part, the long term debt, because this company does not require a lot of capital expenditure, and so they don't require to take out a whole lot of loans. They do have long term debt though, so this allows them to grow, but for a company like this who has a lot of free cash flow, the long term debt to finance their capital expenditures is not as necessary as, say, an oil or gas company. Because with an oil or gas company, just really quickly, you need to be constantly growing, constantly finding underdeveloped wells, acquiring other companies and land in order to grow. And so if you're not growing, you're declining. And so that's why, you see companies like Occidental with a whole lot of long-term debt. I think it's 18 billion, if I'm not mistaken, just so that they can grow as a company. But SiriusXM doesn't fall under that category because it is a capital-light business. It has ROIC, return on invested capital, of over 20%, as well as an operating margin over 20%, which is very impressive. They have long-term revenue and income growth. So for the past few years, the net income for SiriusXM has sort of plateaued. The reason is that they've had falling revenues during this shift of people moving away from subscriptions towards ad-based revenue. So for the foreseeable future, their subscribers are going to decline, and as they adhere to a cheaper subscription plan and don't increase the price, you're going to see a short-term plateau or decline in revenue. And that is okay because they're going through a kind of transformative period, and it's also for a good reason. If they were to increase prices and artificially increase their revenue, that would not have a good long-term outlook because you would be losing customers. So this company clearly, by their actions of keeping their subscription prices low, definitely values customer retention, and that's one of the most important things about a business. And they also have a very low valuation, about 7x is the PE, and they had a huge sell-off recently. Even though the net income hasn't slipped, it's stayed pretty much the same. And finally, their interest coverage ratio, which is because they have some debt, they need to pay off the debt. It's healthy. It's good to look at the net income over the charges on that debt every year to make sure that they're able to cover the interest that their debt is accruing. And for SiriusXM, that ratio from net income to interest expenses each year is about 3 times, which is healthy under the standards of Graham and Dodd. And finally, the red category is management. So this is something that I've been kind of learning more recently. Warren Buffett's ability and preference for choosing the most authentic CEOs for owning the businesses that he acquires. I think that it's an important thing to look at, even though it's not quantifiable, but it's important to check out the CEO, see if they seem authentic, even just in interviews online that you find. I think that you can tell a lot from how a CEO conducts themselves in an interview. And so I ask questions like, has the CEO been with the company for a long time? Did they move up from the bottom? Were they starting as an associate or a salesman and they moved all the way up? That would be ideal. Do they demonstrate authenticity and convictions or confidence on video? So that's someone who is probably more going to be a little bit more resilient during hard times, which is important. And finally, would you mind working with this person? It's kind of a silly question, only investing in companies which you would personally work with the CEO, but it's important because if let's say you look up a CEO and they're extremely depressing or not interesting to listen to at all, that can be a bad sign, because maybe their employees are kind of uh, getting the same type of attitude at their job, and that isn't conducive for a good culture. So the CEO of SiriusXM has been with the company for 22 years. They worked their way up through different management roles. They do demonstrate authenticity and conviction on video, and she does seem pleasant to work with. And of course, she is also vouched for by Warren Buffett. So I want to end off this video by saying SiriusXM recently was bought up by Warren Buffett, and that's another good reason to buy such a stock. So, yeah, I hope you guys enjoyed. These are some of the factors that you want to look for, and I will see you in the next video.